Hello everyone, welcome to our revenue management video. So for this video today we'll have a different person talking, myself as a general manager, then we have a finance manager, that is Emily, financial officer, that is Alice, investment manager, that is Roman, reservation manager, that is Michelle, and last but not least, the general manager assistant, Carlota. Our plan for this video, that's a little introduction, then analysis and findings, performance, and lastly our recommendations. So welcome in our new podcast about revenue management with High Five Hotel. We ran this hotel for a year and analyzed our performance. So for the background, the hotel is a 250 room hotel that's operating in a buyer's market. What that means? That means the guests have the power to determine what they want for the price they want. Therefore, we can say that the clients expect exceptional value at a discounted price. The hotel has been in a steady decline of performance over the past years. For example, we can see that the occupancy has decreased from just below 80% to 55% in just 3 years, which is quite a big decrease. Because of the profits operation decreased, no refurbishment nor investments were made as well. So for our positioning statement and our position of the hotel, we seek for the highest quality possible. Our goal is to give the best quality we can. The target market is business travelers, and our positioning statement is for business travelers who seek a full service hotel with Wi-Fi, business center, executive lounge and an express check-in check-out. High Five Hotel is the perfect alliance between comfort and business. For the pricing strategy, we wanted to follow the logic of a scheme price strategy. To do so, we had an extremely high premium room price to force guests to purchase standard room, which were prices was a little bit above competition. So we were forcing them and showing them with a decoy price that the premium price was too expensive to bring them back to the standard price so that they can think it's a good price, but it's still above competition. We also did higher prices during weekday compared to weekend to align with the demand that was higher during weekday than weekends. And we did this except for tours where the demand was higher during weekends. So we placed higher prices during the weekend.
Diving to our analysis and findings, we're going to take a quick look at our revenue performance over the 4 quarters. The highlights are that we've noticed that our net profit is the highest during the 3rd quarter due to the highest demand during the summertime. We also noticed at the end of Q2, we have an increasing service facility that leads to the higher demand of our hotel. We also noticed that after Q2, we have a consistent guest satisfaction rating on our facilities. Due to the high management fees, we decreased our refurbishments during the 3rd quarter. And now moving on to another revenue performance, we're going to analyze the market penetration indexes throughout the 4 quarters. So what we did really well was that Hotel High Five's RevPAR index has always been above the competition set throughout the whole year. The occupancy index also remains mostly above the competition set, except for the November after the peak season when occupancy decreased. The MPI discounted remains over the competition set all throughout the year as well. However, what we do need to improve, and what we noticed and then what we did improve, was that the ADR index remains rather low compared to the competition set. However, our strategy was to keep our prices low, but then after the 3rd quarter, we did increase the ADR, which was good. Also, the MPI and the transient also remains rather low, especially through quarters 1 and 2, due to the fact that we targeted the transient guests. So in order to show the market penetration indexes on a graph, we've made this line graph that displays that there's notably an increase in the ADR after the 2nd quarter, and also how occupancy rate fluctuates due to the change in prices throughout the whole year. So now we have a line graph displaying the MPIs for the transient, discounted, and group guests. So the MPI for discounted guests remain well above the competition baseline, and the MPI transient remains below the competition set.
Alright, so jumping into market segments and the occupancy distribution. So we can see that our overall market segment occupancy has remained more or less constant during the year with minor exceptions. Another observation is that the decision about selling very high prices for premium category to make customers focus mainly on standard rate has paid off, as it created most of our revenue. In the third quarter, our decision led to maximizing revenue from standard segment while lowering two segments that were less profitable. And finally, in the fourth quarter, we have focused more on groups, tours, and package deals because of low demand for higher categories. All right, so now let's talk about distribution channel. During the second quarter, we increased the percentage of room night bookings, number of rooms that we forecasted to be sold. We increased the percentage for the transient guests through direct booking because that is the customers we sold most rooms to at their standard and premium rate. And finally, the fourth largest segment sold to is guaranteed. Therefore, we increased that. All right, so staying with the distribution channel, for the second quarter, we decreased the percentage for the transient guests through GDS because we are not selling that many rooms to that distribution channel, so our efforts were to go elsewhere. And we decreased the percentage for the wholesale as well due to the same reason.
Now we're going to analyze the weekends versus the weekdays. We increased the ADR from 185 to 191 for the quarter two as we expected the occupancy to increase. And we can see from previous years that when the occupancy increased during weekdays, several segments were affected, especially premium, bar, tours, and small groups. We increased the pickup consistently to increase the occupancy rate, which is now at 72%. Before, it was 56%. August is the peak season, and therefore the prices were increased to match the demand. During October, the demand decreased again, and therefore we decreased the pickup and prices to match the demand, cutting some of our advertising expenses, and we modified channel management.
So now let's jump into guest satisfaction versus refurbishment. So as our budget was smaller in the first quarter, we have not spent a lot of resources on refurbishment, which can be observed by lower guest satisfaction in the first quarter. Secondly, however, in the second quarter, we have spent significantly more on refurbishment and services like valet service, foreign exchange, and lobby kiosk, since that's what our target segments demands. The guest satisfaction has increased to 67% as a result of increased spending in refurbishment. We have not commenced any refurbishments in third quarter as we were saving money for fourth quarter. However, the guest satisfaction has not diminished since we have ordered many refurbishments in second quarter with due date in the third quarter. And finally, in the fourth quarter, there have not been any substantial investments. We focused on upkeep of the already existing facilities, keeping the guest satisfaction high.
For the performance of the hotel 5.5, this is what we expected for this year. So quarter one, we expected a moderate growth in business and corporate demand and also an increase in the use of our restaurants. However, on the negative side, we thought that the ADR was going to grow very slowly because we needed to add more facilities. In terms of the second quarter, we expect to have a growth of leisure and business segments, as well as an increase in requests for proposal and contract business. On the negative aspect, the customers are still price sensitive, but are willing to pay more if the hotels offers facilities that are in clean and good condition. For the third quarter, we expect to have a new cost airline that will increase the load factor by 20%. So this will enhance the tourist segment. And in terms of the summer occupancies, we expect them to go up to 65%. However, we do expect the unemployment rate to still enable us to not have a revenue that's this high. And for the fourth quarter, we expect the occupancies to lower a little bit as it is a lower demand season. However, we do expect the leisure demand to continue. In terms of our performance, we were able to analyze our hotel with our KPIs. We were able to see that the third quarter was the most successful quarter. We calculated the ADR, occupancy rate, revenue per available room, and the main market indicators. We were able to see that the third quarter was the most successful, first of all due to a high ADR of $198 per room. Secondly, our occupancy rate was at its highest with a 70%, and our revenue per available room jumped to $139 per room. This is also due to the fact that summer season can guarantee a high demand, so we were able in advance to implement a high ADR. We also saw that our rate efficiency was at its highest, which shows our good implementation of our scheme pricing strategy. We were also able to analyze our performance by looking at our revenue and our expenses. Our first quarter had a very low revenue because it is a low demand season and hence we were only able to implement a low ADR. For our second quarter, we were able to have an increase in rooms income as well as a slight increase in other departments as we started to implement our facilities. This, however, led to an increase in expenses such as administrative and general expenses, as well as property operations and maintenance expenses. Our third quarter, however, had no significant increases in expenses except for the marketing and advertisement, which overall led to a higher occupancy rate as we were able to have new customers, and this led to then more rooms revenue. Our fourth quarter had a decrease in performance, especially due to rooms income due to lower demand season and hence lower occupation. And the problem was that our expenses remained high because of all our facilities. But as you can see on the different graphs, we did have quite a stable performance overall. One of the other things we analyzed for our performance was our net profit with our ADR. So we have a big increase in income and in net profit from quarter 2 to quarter 3 as visible on the graph, and we can see a direct correlation as when ADR increases, net profit increases. As we followed the strategy to maximize rate, our occupancy was more at risk. However, we were able to increase our profits as visible on the graph. Our fourth quarter was the least successful as our rates approached the price point limit of the market, which made our occupancy decrease, hence lowering our profits.
Occupancy was higher than our competitors throughout the year except in November. As well, except for November, our ADR was lower than our competitors. So in correlation, we can see that there was one between ADR and occupancy. So the overall analysis for the performance and market indicators is that our RevPAR was overall good, except for the decrease in June to August, which can be explained by our ADR that could have been high. You can see we had 4 group offers overall. And to calculate the group rate, we had to calculate the minimum rate first. So whatever minimum rate we had, we decided to lower the price to be more competitive. For example, the second RFP, where we calculated a minimum rate of 230 and decided to go down to offer a rate of 180. So this was because F&B consumption would compensate the loss in room revenue, and we knew that. So this we did with all 4 group offers. In conclusion, we did not receive any of the group blocks because other teams always offered a much more low and much more interesting rate than we did. However, it was a conscious decision by our team to not lower our rates too much. So concluding with the summary of the year, we finished 3rd in the restaurant simulation with a revenue of over 2 million. And we had an overall strong rate efficiency, which proved that our strategy to maximize rate was successful. We held stable prices with a focus on standards, rooms during the week for the business segment, small groups on weekends, and large groups during the week. The year was a successful one, except for the month of November, where our high ADR did not match with the low demand, which we talked about before. We were not able to accommodate the RFP as our rate offers were too high, but it did not stop us from obtaining a strong revenue.
Okay, so now for our recommendations. Firstly, the short term. So we should adjust prices accordingly to occupancy forecasts in order to match the demand. We should also target transients and large groups. We should make market expenditures accordingly to previous quarter's revenue in order to not spend too much regarding our last revenue. And then we should analyze trigger points. For the long term, we should adjust facility investments throughout the year to meet customers' expectations and reach guest satisfaction. We should as well make decisions according to forecasts and seasonality, and we should implement constant refurbishment. And finally, we're very happy to have participated in this report, and we have learned a lot now from revenue management. And if anyone wants to have a stay or have an experience at our hotel, you can visit www.hotelhighfive.com.